Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we had the OPEC day, so we're going to talk about OPEC and how that is really shifting things and what's that going to do for the remainder of the year, because we're coming into a demand season as we go into November, December, and just looking at the market in general, it is not exactly a very good time to not have a lot of distillates sloshing around. France, and again, in true European fashion, never let a good crisis go without a strike. So there's some strikes going on right now regarding some service stations, some different refiners, and they're tapping into their reserves on the diesel side. So again, there's going to be more pressure just in general outside of just what is happening with OPEC. But in the first segment, we're going to talk about OPEC cuts, by how much is the real cut versus what do they actually say, and then really what does it mean going forward. Then we're going to look at the gasoline spike. So for those that we've been talking about how we expected to see a true up on the gasoline demand, and we thought that there might be more likely to happen now just because Hurricane Ian was going to pull forward some of that demand as people, again, filled up ahead of both the storm hitting not only Florida, but then again the Carolinas and continuing to peter out as it got into the Mid-Atlantic and the tri-state area. Then we're going to look at, how will the OPEC cuts adjust the physical market? Like, where is the physical market right now? And one of the big things is there's a lot of crude that still remains on the floating market. So when you look at what the cuts are actually doing, how much of it is actually going to get driven down, and what is that going to do to price? And one of the things that we've been saying is it just puts prices here. We don't think it goes higher. We don't think it goes lower. And by higher, when you look at WTI, could it go to 92? Sure. Like I am not saying it can't go to 92. Does it go to 250? I don't think so. But again, especially given the geopolitical backdrop and the economic backdrop, but this is going to keep us at a very elevated level and again supports our call on stagflation. We're going to have shortages in different areas that are going to keep supplies fairly tight even as demand comes down, which again is going to create additional stress across the system, keeping what we've been talking about of the Fed tightening. And we're going to talk more tomorrow on the Econ Show when we look at JOLTS, when we look at the Fed. Is this going to force them to pivot? Short answer is no. But again, these are going to be fun things to talk about. So now looking at the cuts. So this is showing you the target. So the current target is the one listed on the left. So Algeria, current target of 1,055,000. And then what they've agreed to, because remember the agreement was for a 2 million barrel a day cut, which is going to be spread across all countries. But so that means that they would cut 48,000 barrels a day. Algeria is currently producing 1,030,000. So again, the cut is smaller. Obviously that's one example. Angola, their new target is 1.45 million. Angola is currently producing 1.16. So no cut. Then you look at Iraq. Iraq is producing at 4.45. Their new target is 4.43. So, okay, it's not a 200,000 barrel a day cut. It's a 20,000 barrel a day cut. And that's what we have to look at when we're saying, okay, this is going against the baseline, not actual production. So it's not going to be a total cut of 2 million. For those that get our insights, I talked about this last week, we expected the actual cut to be about 250,000 barrels. And that, if you start to look at it, it's a little bit higher than 250. It's something closer to 300 to 350,000. And we'll show a chart that, again, identifies exactly why. And the one that's going to have to cut the most, like if you look at UAE, new target is 3.019 million. UAE is currently at 3.35. So, but they were already above their target. So again, that's where the UAE has been producing above their target, and there hasn't been all that much said about it. But then when you look at Saudi Arabia, they've been producing at about 10.97. And so now they're moving from 10.97 to 10.478. So again, it's still a cut. It's just not 526,000 barrels. It's something closer to about when you look at it, about a little bit less than 500. So that's when you start looking at the different math around it, and will they actually cut to those levels when you look at the differentiating factors between the two? Because again, there's going to be reasons that they may try to cheat to one side, but there's also a decent amount of floating storage in the Middle East, which is something that we're going to talk about in segment 3 to look at this. So when you look at the actual OPEC plus output is lagging well behind target. Combined production in September fell about 3.5 million barrels a day short of the planned level. But that's looking at that overcompliance in West Africa, where some places in the Middle East are much closer to or right at, or in the UAE's case, above where they should be producing. So even though there's a 3.5 million barrel shortfall, it's not equal in terms of where is that going to get hit the most, which is why there's going to be some likely creep on some of this when you look at the Middle East. Theory and practice just gives you an idea of the disconnect, where the actual target is closer to about 40 million barrels a day, 41, 42. And then the target is closer to 44. So to bring the 2 million down, you should technically be truing it up, but again, it's not equal across regions. And this is just putting it into perspective. So, and this is obviously a bit of an older chart from Bloomberg, where you see the target cut by 1 million, where that would push Saudi to cut by about 150,000. Clearly, it's 2, so that's where it's obviously closer to over 300,000, closer to 350, 400. But that's when you start looking at some of the different pieces. So Kuwait is something similar, where the cut is going to be much closer to about 750,000. We'll have the full numbers, because as we're recording this, the OPEC discussion is going on. There's a lot of numbers getting thrown around. We'll provide an update again on the FSC show. But just to give you an idea, right now, the actual cut is closer to 500 to 750,000. And we're going to compare that against what is currently in floating storage when you look at the Middle East. And it's also important to say that we're also looking at this with China at obviously a big slowdown. But if they start to speed back up, how quickly could that draw things down? And then again, you also have the other side of, well, in the developed worlds, the economies are getting worse. So would that be enough to offset China? Is that going to be something that'll just put a different type of pressure? And then when you take a look at refining side, and again, to be clear, this is shoulder season. So this is not something that it's like, oh, well, 2.5 million barrels a day is offline permanently and that's going to change. No, that's not. Like, you can see that the drop normally happens, and you have refiners starting to get back to work as we get into the end of October. But and this is another key thing. It's like, sure, there's some builds right now, globally speaking, because we're in shoulder season. But as things ramp back up, that's going to draw some of that excess out of storage. And then when you look at the OPEC side, well, if you're cutting about 750,000 barrels, 500 to 750,000 barrels a day of actual production, what is that going to do? Are you just trying to draw down floating storage? Are you trying to increase the purchasing from other areas? How is that going to deviate? And I think the big key to that answer is going to be, what does Saudi Arabia do with official selling prices going forward? If they cut production and then cut OSPs, well, clearly they're seeing more of a leading indicator for the demand side. But if they raise OSPs and cut production, well, clearly they're really trying to hone in on this price closer to about, let's call it between $85 and $95. And I know that's a very wide target, but it's just purely because the volatility in there. And it's just, they want to keep this on an average price of what seems to be about between $90 and $91 on, and again, then if you look at the Brent side, the math is closer to about $95 in general. which is, I think, really where we're going to drift higher. And as we made the call back in the middle, in the beginning of August, and I should say the summer, and then I did the interview with the I think it was out of Nigeria or Kenya, I apologize, in terms of just discussing where we thought prices were. And we kind of copped out, because this was when Brent prices were at 102. We're like, we just think it's here. And again, it's obviously come down a bit, but now it's starting to come back. And there's a lot of staying power right at this pricing level, just based on where we sit at this point in time. You know, the other key thing, and we're going to talk about this again more in the Econ show, is Saudi Arabia's foreign assets. You know, when you look at the movements in general, they've really kind of stopped buying a lot of this excess, because their foreign assets are building up naturally. When you think about just the sale of crude in US dollars, it's naturally bringing in that USD, so they're not looking to turn around and buy additional, and they're actually buying less debt in treasuries, and they're just going to sit on these dollars, which I think is going to become a much bigger issue as we, again, move forward with China, Japan, net sellers, Fed, a net seller, yet we still run a deficit. So we're increasing supply still, not only new supply, but rolling debt. And the three biggest buyers of the last 30 years are now gone. And they're actually net sellers. So gives you an idea of kind of where rates are headed in general. So now when we look at the global backdrop, the total oil and product stockpiles, the deficit narrowed from negative 12.5 to negative 4.6. And you can see we're getting close, right on the nose when you're looking at the normal side. And again, this is a global look. So and that's factoring in crude, with crude and floating storage, and land storage is actually now in a surplus. Gasoline, steep surplus. The distillate side is just horrendous. And that's something that we're going to talk about, with the U.S. in a very dire straits when you consider where we are on the distillate side, and things keep getting worse, and we are not even in winter yet. So again, that's when you look at the commentary that's been coming out of the White House about gasoline prices. It's like, gasoline prices is one thing, but we really need to look at where things are on the distillate side. So crude stocks, total crude stocks, land and floating, the surplus widened from 25.5 to 44.3. There's still a significant amount that some of it has gone from floating to land, but there's still a record amount in transit, a record amount of crude on the water. So again, that's going to remain elevated. Total oil product stockpiles are right at 2021 levels. The deficit widened from 38 to 48.9. And again, that is all on the back of distillate. And that's where you have that backdrop. China has issued about a 20 million ton crude import quota to private refiners in the first batch of allocations for 2023. More than 20 teapot refiners received the quotas. The first batch for 2023, which has been released much earlier than usual, but is much smaller than 2022's first batch, which came to 109 million tons. So again, there's still that huge, and it doesn't mean that there can't be additional, but they have a lot of crude in storage, and we've been talking about how they're going to want to get through that, especially based on what is sitting in floating storage as well as onshore storage. Land storage is back above 2021 levels. The deficit narrowed from 29.5 to 28.5. West of Suez was the biggest driver. When you look at, east of Suez was the biggest driver, but west of Suez is fairly normal, right? Just below normal in terms of what is on land. The deficit widened from 7.7 to 12.6. But you can see, again, right in that cloud, and a lot of that is being driven based on Pad 3, what's in the Gulf of Mexico, as well as Europe, which things are fairly, normal, if you will, against historics, while there's extremes within that, especially in Pad 2. East of Suez, the deficit narrowed from 21.9 to 14.9. We're now above 2021 levels, and that's something that we think is going to continue to move higher. Now, when you look at floating storage, floating surplus narrowed from 51 to 32.1, which is, again, that transfer from offshore to onshore. But there's more, and then there's also some of this crude that went into transit. So there's a mixture of what has been transitioned from floating to onshore, but also what has now gone into motion and will find a home. West of Suez, the deficit widened from 2.4 to 7, and surplus narrowed in east of Suez from 50.7 to 41.9, with a lot of that being driven by purely Asia, as the Middle East and West Africa still remain at elevated levels. India's diesel sales rebounded in September, which again we've been talking about was going to continue to be the case, both in terms of exports as well as local consumption. We do see that coming down in terms of the pain that is happening in India and again a lot of these other areas. And one of the pieces that is now happening with OPEC again kind of supporting prices at these levels, you're going to see that additional pain when you look at inflation and those import and input costs remaining high. Now, when you look at the U.S., had a draw of 1.36 million. It was driven by Pad 5, which had a draw of 1.77 million, which puts them just 1 million below the 5 years. So things are fairly normal. In Pad 3 is 9.3 million above the 5 year. Pad 4 is 1.2. So again, the real driver of the shortages is Pad 2, even though Pad 2 here had a build of 2 million as imports from Canada continues to come down, but they still have the Toledo refiner offline, so that's going to keep things moving through. With Cushing continuing to see builds of another small, as we've been saying, small 270,000 barrels increase, and they're right about 17.6 million below the 5 year, but that's something that we think can close fairly quickly just given where that demand side is, but it's going to put more stress on the refined product side, which again is that offset. When you factor in the SPR, there was a draw of 7.55 million, which is again going to remain. And just given what has happened now with OPEC will remain the case as well, with a lot of that being sour. And then when you look at production, it was still down that 100,000 at 12 million. That will come back up, especially as Ian has passed. People get back to some of the platforms that were evacuated just for safety. They should be back this week, or they started last week, and again fully ramped up. And then we'll start to see that get back to normal. And then as those in that were in the path of Hurricane Ian continue to build and dig out and start the process of rebuilding. So now when we look at Pad 3, it's the third highest it's ever been. The only two times it has been higher was 2020 as well as 2016. So again, on the crude side, there is not that issue, but there's a mixture of, imports came down, but again, exports are still remaining robust, and we're going to continue to see exports remain strong, as especially now with the OPEC decision. But though, remember, Libya it doesn't have to follow those. So Libya is continuing to push into the market. Norway and the North Sea is at a 13-month high. That is going to help as well. But there's still a lot of demand for U.S. exports, which we'll talk about in segment 3. Crude oil Cushing, as we've been saying, creeping higher. Typically this is the time when they start to rise, and we just think it'll be a very slow grind higher, very much in line with the seasonal rally, but obviously from a much lower starting point. Runs were up 0.7. That was mostly essentially Pad 2 through Pad 5. There were increases. They were all small. The Pad 3 was the only one that had a bigger increase, and that's just some things were taken slower. They didn't turn anything off. They reduced some of the runs just as Ian came through, and now that is back and operational. U.S. import of European gasoline was dropped a bit. It came in at about 239,000 barrels a day. That's something that we should see grind a little bit higher, but still the cost of shipping is still very expensive, so the ARB can fluctuate depending on what kind of deal you're getting. Utilization rates, as you can see, a small increase, but still trending in that direction. We'll continue to see there's some more announcements in terms of things coming offline just along the October maintenance season, and then typically that starts to reverse as we get into the end of October, beginning of November. So nothing too crazy in that regard. Then when we look at imports were down 502,000 barrels a day. That's 682,000 below the 5 year. And it was, pad 2, as we said last week, was going to have a drop, but still remain strong. We're still well above the 5-year average. That's going to remain robust. And then pad 3, again, some of that timing delay, we will see some of that recover, but still remaining well off the 5-year average. So nothing too new there. And this just gives you an idea. Because of the storm, some patterns can get adjusted, hold off a bit, and so there will be a bit of a makeup. But it's still going to be at the low end of the cloud, still very, very much below the 5-year average. So not a huge shift in that regard. And then when you look at pad 2, the other side where we said it's going to remain well above the 5-year average, setting either new all-time highs or at least, again, holding very firm above that average of the 5-year as product continues to flow south. From, again, Canada into pad 2. Implied demand, so 640,000 barrels a day increase in gasoline from 8.8 to 9.46. Again, there's a lot in that. There's the makeup number because some of the numbers over the last couple of weeks have been too low. And then you had Hurricane Ian where everybody rushes to fill up their cars, make sure that they have the gasoline available. So typically you get that spike and then that's hard drop off. And we just think it's going to come closer to that 8.6, 8.7 million level. It could go further because those that rushed and bought gasoline aren't going to need to go buy gasoline immediately because a lot of people didn't go anywhere during the storms. So you could see 2 weeks of that drop off. But again, that 8.6, 8.7 still remains pretty firm. Distillate still holding, drop small. We think it'll average about 3.8, 3.9, and then again start to accelerate as we head into the winter. And then jet is right within our comfort zone of that 1.45, 1.55. We don't see that changing. With propane, propylene right at 12, a small increase of 12,000 barrels a day. Still staying fairly firm. And a lot of that is just driven based on the export market because the petchem side still remains fairly sluggish. When you look at implied demand, you can see the big makeup number. Typically, there's a trend down at this point. Instead, there was a nice spike higher. When you look at it on the data sets, it's the highest ever on a seasonally adjusted basis. So again, there is a lot in that in terms of the makeup numbers, the Hurricane Ian, and as that abates, again, you'll see that come back down. And what we think is going to be much closer to that 29-year average, which is about that 8.6, 8.7. Crude oil inventories, excluding SPR, fairly flat. Again, this is what we've been saying. It's going to be sideways and then start to creep. Typically it starts to creep higher as we go into the winter months. But now with the shift in OPEC's policy, does that adjust? And again, this is the problem because if you're talking about, let's say, a 97 million barrel a day demand, 100 million barrel a day demand scenario, 750,000 barrels a day decline in supply. Well, where's demand? Demand could be down 1.2 million. Yeah, and it's going to be hard to see that until we see that move through. Obviously, with the floating storage, it looks like that is the right number. But again, with that number being the balanced approach in terms of taking that off the market, well, that's not going to drive prices down. So you're just going to, again, kind of hang out here unless we see another big demand drop, which results in more crude coming off the more demand, which would put more crude on the water. So that's why we look so hard at what is happening with storage, what is happening with some of these movements. Crude oil supply, again, just tracking fairly normal. We don't see that adjusting versus historics. Commercial oil storage and products, you can see, again, fairly flat. It obviously moves up and down. We just see this being as a sideways move. But the bigger problem is going to be on the distillate side because even though when you factor in all of crude, it's fairly flat. When you look at gasoline, it's come down a bit, but we do see that coming back. It's the disty side. The disty side is going to continue to be the biggest driving force. As you can see, gasoline storage is right at about the 29-year average. There was a lot of that, again, moving through, filling that demand ahead of Hurricane Ian. We do see that, again, dropping off a bit, which is going to put more of this into storage. While distillate, before we've said things have been bad, now they are getting worse. This is distillate on on the U.S. level. So we're just right at all-time lows, or the lowest in the last 29 years. It's bad. It's bad for pricing, for the consumer, for input costs, and that's something that is only going to get exacerbated as we head into the winter months, where our jet fuel following something closer to 2021, but we're seeing again that steadiness in terms of the jet fuel side. But again, kerosene can be diesel, and what bucket are they going to push it into? And that is going to keep jet fuel expensive. As we said, the belly of the curve didn't make much sense based on where it had gone. We're starting to see a little bit of that strengthening. There's still that kind of overarching concern of, well, where is demand going to go if we do get a big recession? And that is where you're still seeing some of that muted. The front month is going to dance. That's something that we think is going to remain the case. And you can day trade it, you can trade it in and out, but it's the belly of the curve that we think has the most opportunity. And then here you can see floating storage came up a bit, and that again is going to trend a little bit higher, and we will see additional product going from offshore to onshore, which we do see with a small step up in imports into Pad 3. So that's what we have for you on that. There's a lot to discuss on OPEC. We'll cover more on Friday, and then we'll have a bit more as we go through the second half, segment 3, and how that OPEC decision is really going to drive some of those international markets.